What if I told you that right now, today, with as little as $50, you could start building a portfolio that historically doubles every 7 to 10 years, without picking individual stocks, without timing the market, and without a finance degree? Most people are working 40, 50, 60 hours a week and getting absolutely nowhere financially. They're spending everything they earn and leaving nothing behind. But the people who quietly build real generational wealth, they figured out one simple system decades ago, and it involves something called ETFs. Stay with me for the next 12 minutes, because by the end of this video, you'll have a complete long-term ETF strategy that could change your financial life forever. And if this is the kind of content that makes you think differently about money, hit that subscribe button and smash the bell right now. We drop strategies every week that most people never learn in school. Let's get into it. Okay, so first, what exactly is an ETF? ETF stands for Exchange Traded Fund. Think of it like this. Instead of buying one single stock and betting everything on one company, an ETF lets you buy a tiny slice of hundreds, sometimes thousands, of companies all at once. It's the ultimate diversification tool, and the reason it's so powerful is that you get instant exposure to the entire market or specific sectors of it for one simple price. Often less than the cost of a single share of a major company. ETFs trade on the stock market just like individual stocks. You can buy them anytime the market is open, but unlike individual stocks, they carry dramatically lower risk because your money is spread across so many different companies. Now, here's the key insight most people miss. The goal of long-term ETF investing isn't to get rich overnight, it's to get rich inevitably. There's a massive difference. Let me show you why. In 60 seconds, I'll show you the exact three-part ETF portfolio that most millionaires end up with. But first, you need to understand why the math makes this almost unfair. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the math doesn't lie. 400-month invested at 10% average annual return. After 10 years, $82,000. After 20 years, $275,000. After 30 years, $790,000. After 35 years, $1,260,000 plus. Here's what's wild. In this example, you only personally contributed around $168,000 over 35 years, but you ended up with over £1.3 million. That extra 1.1 million, that's compound growth doing the heavy lifting for you. And the global stock market, which is what many ETFs track, has historically returned around 10% per year on average over long periods. Even adjusted for inflation, that's roughly 7%. Your money is silently multiplying while you sleep, while you work, while you live your life. The biggest mistake most investors make? Waiting for the perfect time to invest. There is no perfect time. Every year you wait is compound growth. You're never getting back. And the biggest ETF mistake? It's not picking the wrong fund. It's what people do during crashes. I'll show you exactly what that looks like and how to avoid it in just a few minutes. All right, let's build your actual strategy. This is the part you're going to want to screenshot or bookmark, because this is a framework thousands of successful long-term investors use. The foundation of a long-term ETF strategy rests on 3 pillars. 1. Core holdings, broad market exposure. 2. Growth layer, targeted upside. 3. Stability layer, downside protection. Your core holdings should make up about 60% of your portfolio. These are ETFs that track the entire US market or the S&P 500. Some of the most well-known options in this category include funds that track the S&P 500 index, the 500 largest US companies. You're buying a piece of Apple, Microsoft, Amazon, Nvidia, and hundreds more with a single purchase. Why 60%? Because historically, broad US market ETFs have been the most consistent long-term wealth builders available to everyday investors. You're not gambling on any single company. You're betting on the entire American economy. And over any 20-year period in history, that bet has paid off. The next 25% is your growth layer. This is where you add a little firepower to your portfolio. Think ETFs focused on technology, healthcare, or emerging international markets. Why international? Because the US won't always be the fastest growing economy in the world. By spreading into international ETFs, you capture growth from rising economies in Asia, Europe, and beyond. This also protects you if the US market underperforms for a decade, which has happened before. Technology ETFs are another popular choice here, tracking industries like artificial intelligence, semiconductors, and cloud computing. These can grow faster than the broader market, but they also carry more volatility. That's why they're only 25%, enough to boost your returns without exposing you to unnecessary risk. Finally, the last 15% is your stability layer. This includes bond ETFs and dividend-focused ETFs. Bonds move opposite to stocks during market crashes. When the stock market drops 30%, bond ETFs often hold their value or even go up. This is your shock absorber. Dividend ETFs give you something even better: cash flow. These are ETFs that own companies who pay dividends regularly. You get paid just for holding them. And if you reinvest those dividends, that's more compound growth stacking on top of everything else. In a minute, I'll show you the boring habit that beats 90% of investors. It requires almost zero effort, and most people never use it. Now that you have your portfolio structure, here's the single most powerful habit you can build: dollar cost averaging, or DCA. It sounds fancy. It's not. Dollar cost averaging simply means investing the same fixed amount of money on a regular schedule, every week, every 2 weeks, or every month. No matter what the market is doing. When the market is UP, you buy fewer shares. When the market is down, you automatically buy more shares at a discount. Over time, this averages out your cost basis and removes the emotional guesswork of, should I invest now or wait? Here's the most important part. Market downturns are not disasters for the long-term investor. They are sales. When the market drops 20%, your regular monthly investment buys 20% more ETF shares. You want the market to crash early in your investing journey. It's free money. Set it up once, automate it, then go live your life. That's the power of DCA. This next part is why most people never get rich, even with the perfect ETF. Pay close attention, because this is where most investors quietly sabotage themselves. Alright, we need to talk about what will absolutely ruin your long-term strategy. These 3 mistakes wipe out more wealth than any market crash ever has. Mistake number 1, panic selling. When the market drops, and it will drop, most people panic. They sell everything to stop the bleeding. Then the market recovers, they wait until it hits a new high, and they buy back in at the top. Buy high, sell low, the exact opposite of what builds wealth. The data is brutal here. Studies show that the average investor significantly underperforms the market over time, not because the market is unfair, but because they keep making emotional decisions. Stay the course. That's it. Mistake number 2, chasing performance. Last year's hottest ETF will probably not be next year's winner. Constantly shifting money from ETF to ETF based on recent performance is a guaranteed way to buy high and sell low repeatedly. Your long-term strategy should stay relatively boring, and that's a feature, not a bug. Mistake number 3, ignoring fees. This one is sneaky. A fund charging 1% per year sounds tiny, but over 30 years on a large portfolio, that 1% can cost you hundreds of thousands of pounds in lost compounding. Always look for ETFs with low expense ratios, ideally below 0.2%. The difference adds up to life-changing sums over decades. Once you've built your portfolio, you don't just leave it completely untouched forever. Once or twice a year, you rebalance. Here's what that means. Let's say your tech ETFs had a massive year and now they represent 40% of your portfolio instead of 25%. Your portfolio has drifted from your target allocation. Rebalancing means selling a little of what grew too much and buying a little more of what fell behind, bringing everything back to your original percentages. This sounds simple, but it enforces a powerful discipline. It forces you to sell high and buy low automatically. You don't need to feel anything. The strategy tells you what to do. Set a calendar reminder twice a year. Review your allocations. Rebalance if anything has drifted by more than 5 to 10%. That's it. You can build the perfect ETF portfolio, invest consistently for decades, and still quietly lose a huge chunk of your returns if you ignore the tax angle. This is the part most finance videos skip. We're not skipping it. Let's start with the UK, because this is one of the best kept financial secrets in the country. If you're in the UK, your single most powerful move is investing inside a stocks and shares ISA. Inside an ISA, your investment gains and dividends are completely tax-free. You don't pay capital gains tax when you sell. You don't pay income tax on dividends. Every penny of growth stays with you. That is an extraordinary advantage that most people never fully use. On top of that, if you're contributing to a workplace pension or a SIPP, a self-invested personal pension, you also get tax relief on contributions, meaning the government is essentially topping up your investment for free based on your income tax rate. That's free money most people leave on the table. Now, if you're based in Europe or elsewhere in the world, the principle stays exactly the same. Every country has its own version of a tax-efficient account. In France, it's the PE. In Germany, the Freistellungsauftrag exemption. In Ireland, ETFs are taxed differently and worth researching specifically. Whatever country you're in, your first move should always be to understand and maximize the most tax-efficient account available to you. There's also one more thing to be aware of, and this one surprises a lot of new investors. ETFs come in two types: accumulating and distributing. Accumulating ETFs automatically reinvest your dividends back into the fund. No action needed, maximum compounding. Distributing ETFs pay dividends out to you as cash. Depending on your country, one may be more tax efficient than the other. In the UK, accumulating ETFs inside an ISA are often the cleanest option. But the rules can vary, so always check the specifics for where you live or speak to a qualified financial advisor. The takeaway is simple. It's not about how much your portfolio grows. It's about how much of that growth you actually get to keep. Tax efficiency is the invisible multiplier on everything we've talked about today. At the end of this video, I'll give you a 5-step action plan you can start today with as little as $50. Don't go anywhere. Here is your complete action plan. 5 steps. Start today. Step 1. Open a tax-efficient investment account. A stocks and shares ISA in the UK or the equivalent in your country. Most platforms let you start with no minimum, and many offer free apps to manage everything from your phone. Step 2. Choose your ETF allocation. 60% broad market, 25% growth, 15% stability. Adjust slightly based on your age and risk tolerance. Step 3. Set up automatic monthly contributions. Whatever amount you can afford consistently. Even $50 or $100 a month gets the machine moving. Automate it so you never have to think about it. Step 4. Turn on automatic dividend reinvestment, or choose accumulating ETFs that do this for you automatically. Every dividend gets recycled back into growth. Step 5. Rebalance twice a year. Set a calendar reminder, review your allocations, adjust if anything has drifted by more than 5 to 10%, walk away. That's the whole system. Not complicated, not exciting, incredibly effective. Real wealth isn't built in a day. It's built in decisions. Small, consistent, boring decisions made over years and decades. ETFs give everyday people access to the exact same wealth-building tools that billionaires use. The only difference between you and the person who retires with $1 million is starting and not stopping. You now have the strategy. The question is, will you use it? If this video gave you real value, subscribe right now. We break down wealth-building strategies every single week in plain language that actually makes sense. Hit the like button if you learned something new today. It genuinely helps this channel reach more people who need this information. I'll see you in the next one. Now go build something real.